I have been studying the economy very carefully over the past several months, and I need to tell you about something that deeply concerns me. I am seeing warning signs in three specific sectors of the economy that suggest we could be heading for significant disruptions, possibly as soon as March of 2026. Now, when I say collapse, I do not mean that these sectors will disappear entirely or that every company in them will go bankrupt. What I mean is that we could see severe financial stress, massive job losses, credit problems, and substantial wealth destruction concentrated in these three areas. I want to be very clear about why I am speaking out about this now. I do not make predictions lightly. I do not try to time markets or forecast short-term movements. But what I am seeing in these three sectors is not speculation or guesswork. These are fundamental problems that have been building for years, and the timeline for when they become critical is getting very short. The signs are there for anyone who knows where to look, and March matters because that is when several critical deadlines, refinancing needs, and seasonal patterns converge in ways that could trigger cascading problems. Let me walk you through each of these three sectors, explain what is wrong, why March is the critical period, and what you should do to protect yourself if you have exposure to these areas, either through your investments, your employment, or your business relationships. The first sector that I believe could collapse by March is commercial real estate, and specifically office buildings. This is not a controversial opinion at this point.
Everyone knows that office real estate has been struggling since the pandemic. Remote work and hybrid work arrangements have dramatically reduced the demand for office space.
Companies that used to lease 5 floors now lease 2. Companies that used to require employees in the office 5 days per week now allow 3 days remote. And some companies have gone fully remote, giving up their office space entirely. But here is what most people do not understand about the timeline and the severity of the problem. When the pandemic hit in 2020, most office leases did not expire immediately. Commercial real estate leases are typically 7 to 10 years long. So companies kept paying rent on space they were not using because they were locked into their leases. Landlords kept collecting rent even though the buildings were empty. The occupancy rates plummeted, but the cash flows to landlords remained relatively stable because of these long-term leases. But now, 5 years later, those leases are starting to expire. And when they come up for renewal, companies are either not renewing at all or they are renewing for much smaller spaces at much lower rents. The vacancy rates in major cities are approaching 30 or even 40% in some markets, and the buildings that are occupied are generating far less rent per square foot than they were 5 years ago. This creates a massive problem for the owners of these buildings, and here is where March becomes critical. Many of these office buildings were purchased with debt. The owners borrowed money to buy the buildings, expecting that rental income would cover the mortgage payments and provide a return on equity. But now the rental income has collapsed while the mortgage payments have stayed the same or even increased as interest rates have risen. A huge wave of commercial real estate debt is coming due in the first quarter of 2026. These are loans that were originated 7 or 10 years ago that are maturing and need to be refinanced. Under normal circumstances, refinancing commercial real estate debt is routine. You simply go to a bank or other lender, show them that the building is generating income, and they give you a new loan to pay off the old loan. But circumstances are not normal. The buildings are not generating enough income to support the debt. The valuations have collapsed because the income has collapsed. A building that was worth $500 million when it was 90% occupied and generating strong rents might only be worth $200 million. Now that it is 40% occupied and generating weak rents, and lenders are not willing to refinance loans on properties that are worth less than the loan amount. What happens when a commercial real estate loan cannot be refinanced? The borrower defaults, the lender forecloses, the building goes into bankruptcy or receivership. And this triggers a cascade of problems. The lender, often a bank, has to write down the value of the loan, which hits their capital ratios and their earnings. If enough of these loans go bad simultaneously, it could threaten the solvency of regional banks that have heavy exposure to commercial real estate. The borrowers, often real estate investment trusts or private equity funds, suffer devastating losses. Investors in those funds lose money. employees lose jobs. The construction and property management and all the ancillary industries that support commercial real estate get hit. Local governments lose property tax revenue as building values decline. It is a cascading effect that spreads well beyond just the building owners and lenders. And it is all coming to a head in the first quarter of 2026 because that is when this massive wave of debt matures. I have seen estimates that there are hundreds of billions of dollars of commercial office real estate loans maturing in the next 6 months. Many of them will not be able to refinance. Many will default. And the concentration of these defaults in a short time period could trigger a crisis. Now, some people will say that this problem is well known, that everyone sees it coming, that it is already priced into the market, and to some extent that is true. Commercial real estate stocks have been declining. Some buildings have already been sold at steep discounts. Some loans have already been restructured or written down. But I do not think the market fully appreciates the scale of what is coming or the potential for contagion into the broader financial system. What should you do if you have exposure to commercial office real estate? If you own REITs that specialize in office buildings, I would seriously consider selling them. The worst is not over. There will be more pain. If you work for a company in the commercial real estate industry, start thinking about your job security and possibly looking for opportunities in other sectors. If you have money in a regional bank that has significant commercial real estate exposure, make sure your deposits are within FDIC insurance limits or consider moving some money to larger, more diversified banks. The second sector that I believe could collapse by March is auto lending, and particularly subprime auto loans. Let me explain what has been happening in the auto lending market over the past few years and why it is setting up for serious problems. During and after the pandemic, car prices exploded. New car prices rose because of supply chain problems, chip shortages, and production disruptions. Used car prices rose even more dramatically because people could not get new cars and bid up the prices of used cars to unprecedented levels. A 3-year-old sedan that would have sold for $20,000 in 2019 was selling for $35,000 in 2022. Consumers still needed cars, so they borrowed money to buy these very expensive vehicles. And lenders, flush with cash and chasing yield, were happy to lend. They offered longer loan terms, up to 7 or even 8 years for a car loan. They reduced down payment requirements. They loosened credit standards, and they lent to borrowers with poor credit scores who would not have qualified for loans under normal circumstances. So you had people borrowing $40,000 or $50,000 to buy cars, stretching their budgets to make the payments, often at high interest rates because of their poor credit. And these loans were based on the inflated values of cars during the pandemic bubble. A person might owe $45,000 on a car that was realistically only worth $35,000, even when the loan was originated. Fast forward to today, car prices have come down from their peaks, though they are still elevated compared to pre-pandemic levels. But the loans are still outstanding at the inflated amounts. And now we are seeing delinquency rates rise sharply. People who stretch to afford these car payments are starting to fall behind. Some are defaulting. Some are having their cars repossessed. When a car is repossessed, the lender sells it at auction to recover what they can. But here is the problem. The car sells for far less than the loan amount because the loan was based on the inflated pandemic pricing. So the lender might have a $45,000 loan on a car that sells at auction for $25,000. That is a $20,000 loss on a single loan. Multiply that by thousands or tens of thousands of defaulted loans, and you have billions of dollars in losses. The lenders who made these loans are in trouble. Some of them are specialized subprime auto lenders who only do this type of lending. Some are the financing arms of auto manufacturers. Some are banks that offer auto loans as part of their consumer lending business. And all of them are seeing their loan portfolios deteriorate rapidly as delinquencies and defaults rise. Why is March the critical time? Several reasons. First, there is a seasonal pattern to auto loan delinquencies. They tend to spike in the first quarter after people have spent money on holidays and are facing credit card bills and tax payments. People prioritize other expenses over their car payment, especially if the car is worth less than they owe on it. Second, many of the loans that were originated in 2021 and 2022 at the peak of the car price bubble are now reaching the point where borrowers are underwater and stressed. These are typically 5 to 7 year loans, so we are now 3 to 4 years in. The borrowers have not built much equity because the loan terms were so stretched and because car prices have declined. They owe more than the car is worth, and they are tired of making high payments on a depreciating asset. Third, the overall economy is showing signs of stress. Employment growth is slowing.
Real wage growth has been negative for much of the past few years because inflation outpaced wage gains. Consumers are stretched thin. Credit card debt is at record levels. Savings rates are low.
And people are making choices about which bills to pay. The car payment often gets deprioritized, especially if they can use public transportation or ride sharing as alternatives. When auto loan defaults spike, several bad things happen. The lenders take losses, which hurts their earnings and their capital. If the losses are large enough, some lenders could fail entirely. We could see subprime auto lenders go bankrupt. We could see banks with heavy auto loan exposure face capital problems. This would tighten credit availability, making it harder for people to get car loans, which would further depress car sales and car prices, creating a negative spiral. The auto manufacturers would be hurt badly. They depend on financing to sell cars. If credit tightens and fewer people can get loans, car sales will plummet. This means production cuts, layoffs, losses at the manufacturers and their suppliers. The auto industry is a huge employer in the United States, with millions of jobs directly and indirectly dependent on healthy car sales. Investors who own securities backed by auto loans, the asset-backed securities market, would see those securities decline in value as the underlying loans default. Some of these securities are held by money market funds, by pension funds, by insurance companies. Losses would spread through the financial system in ways that are hard to predict. What should you do? If you have an auto loan where you owe more than the car's worth, try to pay it down if you can.
Do not miss payments because that destroys your credit score and starts you down the path to default and repossession. If you are thinking about buying a car, wait if possible.
Prices will likely come down further as stressed sellers and repossessions flood the market, and do not stretch to buy more car than you can comfortably afford. If you work in the auto industry, in auto lending, in auto manufacturing, or in related sectors, be aware that there could be significant stress and job losses coming. Have a backup plan. Build your savings. Be prepared for the possibility that your employer might struggle. And if you have investments in auto-related stocks or bonds, particularly subprime auto lenders or asset-backed securities tied to auto loans, you should seriously consider reducing those positions. The third sector that I believe could collapse by March is regional and community banks, particularly those with concentrated exposure to commercial real estate and those with large portfolios of underwater securities. Now, I already mentioned commercial real estate as the first sector at risk, so you might think this is redundant, but the banking angle is distinct and important enough that it deserves separate treatment. Here is what has happened to banks over the past few years. When interest rates were near zero from 2020 to 2022, banks were awash in deposits because the government was sending stimulus checks to everyone. And because people were saving more during the pandemic, banks had more deposits than they had good loans to make. So they invested much of that excess liquidity in bonds, particularly Treasury bonds and mortgage-backed securities. This seemed like a safe, prudent thing to do. Government bonds are the safest asset you can own, right? The problem is that these banks bought long-duration bonds yielding 1 or 2%. And then starting in 2022, the Federal Reserve raised interest rates aggressively to over 5%. When interest rates rise, the value of existing bonds falls. A 10-year Treasury bond yielding 1% becomes worth much less when new 10-year Treasury bonds are yielding 5%. So these banks have huge portfolios of bonds that are underwater, worth significantly less than the banks paid for them. This is not a problem as long as the banks hold the bonds to maturity and do not have to sell them. They can just collect the interest and eventually get their principal back when the bonds mature. But it becomes a big problem if the banks need to sell the bonds to raise cash, because they have to recognize the losses at that point. Why would banks need to sell bonds to raise cash? Because of deposit outflows. And deposit outflows are happening for two reasons. First, depositors can now earn 5% on money market funds or treasury bills instead of essentially zero at their bank. So sophisticated depositors, particularly businesses, have been moving money out of bank deposits into higher yielding alternatives. Second, banks need cash to fund loan losses, including the commercial real estate loan losses I discussed earlier. This creates a dangerous dynamic. Banks have deposits leaving, forcing them to sell underwater bonds at losses. The losses hit their capital ratios. Lower capital ratios make depositors nervous, causing more deposit outflows. More outflows require more bond sales and more realized losses. The bank gets caught in a downward spiral that can lead to failure. We saw exactly this pattern with Silicon Valley Bank in March 2023. The bank had invested heavily in long-duration bonds. Deposit outflows forced them to sell bonds and realize losses. The losses spooked depositors. More depositors withdrew money. Within 48 hours, the bank collapsed. And this was not some tiny institution. This was a $60 billion bank that served thousands of technology companies and startups. After Silicon Valley Bank failed, the government stepped in to guarantee all deposits and prevent contagion. A few other banks failed around the same time. The crisis was contained. But the underlying problems that caused those failures have not been solved. Banks still have huge portfolios of underwater bonds. Deposit outflows are still happening. And now we are adding the stress of commercial real estate loan losses on top of everything else. Why is March the critical time period? For several reasons. First, as I mentioned, there is a wave of commercial real estate debt maturing in the first quarter. When those loans default, the banks holding them take losses. Second,
Tax season creates deposit volatility as businesses draw down deposits to pay taxes. Third, the first quarter is when banks report annual results and when regulators do comprehensive reviews.
problems that have been papered over come to light. Fourth, and most importantly, March 2026 will be 3 years since the Silicon Valley Bank failure. There is a psychological element here. People remember what happened in March 2023. If there are signs of stress at banks in early 2026, depositors will react quickly. They will not wait to see how things develop. They will move their money at the first hint of trouble because they saw how fast SVB collapsed. This creates a hair-trigger situation where even healthy banks could face runs if depositors get spooked. And banks with real problems, banks with heavy commercial real estate exposure or large unrealized losses on securities or both, are extremely vulnerable. I would not be surprised to see multiple bank failures in the first half of 2026, potentially including some institutions much larger than Silicon Valley Bank. What happens if we have a wave of regional bank failures? The immediate impact is on depositors, businesses, and communities served by those banks. Even with FDIC insurance, there is disruption. Accounts get frozen, access to credit disappears. Relationships built over years are lost. The economic impact on local communities can be severe and long-lasting. The broader financial system faces stress as well. Banks that survive become more risk-averse, tightening credit standards and reducing lending. This amplifies economic weakness. Stock markets decline as investors worry about financial system stability. Other financial institutions with exposure to the failed banks take losses. The whole system becomes fragile and prone to further shocks. And there is the question of whether the government response will be as aggressive as it was in 2023. The decision to guarantee all deposits at SVB, even those far above the FDIC insurance limits, was controversial. Some people argued it was necessary to prevent contagion. Others argued it was a bailout that created moral hazard. If there are more bank failures in 2026, there will be intense political pressure not to bail out depositors. But not bailing them out could trigger an even larger crisis. What should you do? First, make absolutely certain that your bank deposits are within FDIC insurance limits. The limit is $250,000 per depositor per bank per ownership category. If you have more than that at a single bank, spread it across multiple banks or use different ownership categories to stay within the insured limits.
Do not assume that your bank is safe just because it has been around for decades or because it seems solid. We are in an environment where even seemingly healthy banks can fail quickly. Second, pay attention to the poorest financial health of your bank. Look at their most recent quarterly earnings report. Look for exposure to commercial real estate loans, particularly office buildings. Look for unrealized losses on their securities portfolio. Look at their capital ratios and their deposit trends. If you see warning signs, move your money to a larger, more diversified bank or to multiple banks to spread your risk. Third, if you have a business that depends on a banking relationship for credit lines or payment processing or other services, make sure you have backup relationships. Do not put all your eggs in one basket. Have accounts at multiple banks. Have alternative sources of credit lined up. Be prepared for the possibility that your primary banking relationship could be disrupted. Fourth, if you own stock in regional or community banks, particularly those with the risk factors I have described, seriously consider selling. The risk-reward ratio is terrible. Even if the bank does not fail, earnings will be under pressure from loan losses and the need to rebuild capital. And if the bank does fail, equity holders get wiped out. There are much better places to invest right now than in stressed regional banks. Now, let me address the obvious question. Could I be wrong about all of this? Could these three sectors weather their problems without collapsing? Of course. I am making predictions based on the data and patterns I see, but the future is inherently uncertain. Policy responses could mitigate the problems. Economic conditions could improve unexpectedly. The timeline could be longer than I expect. But here's what I know with certainty. The problems in these three sectors are real. Commercial office real estate is genuinely struggling with low occupancy and maturing debt. Auto lending has genuinely made too many risky loans at inflated values. Regional banks genuinely have serious exposure to both of these problems, plus their own balance sheet stress from underwater securities. These are facts, not speculation. The question is not whether these sectors have problems. The question is when and how severely those problems will manifest. And my assessment, based on everything I am seeing, is that the first half of 2026, and particularly the March to April timeframe, is when these problems could reach critical mass. The confluence of maturing debt, seasonal patterns, deteriorating economic conditions, and psychological factors creates a perfect storm scenario. What I am trying to do by warning you about this now is give you time to take defensive action. If I am right and these sectors do collapse, the time to protect yourself is before it happens, not after. Once the crisis is underway, it will be too late. Your options will be limited. You will be reacting rather than positioning, and you will likely suffer losses that you could have avoided if you had prepared. If I am wrong and these sectors do not collapse, what is the cost of taking the defensive actions I have recommended? Very little. Selling a REIT that specializes in office buildings might mean you miss some upside if things work out better than expected. Spreading your bank deposits across multiple institutions is a minor inconvenience. Being cautious about auto loans just means you avoid taking on excessive debt. These are sensible risk management steps that make sense regardless of whether my specific predictions come true. This is what I mean by asymmetric risk. The cost of preparing for a crisis that does not happen is small. The cost of not preparing for a crisis that does happen is potentially catastrophic. Given that asymmetry, the rational choice is to prepare to take defensive action to protect yourself and your assets. I want to be very clear about what I am not saying. I am not saying that the entire economy will collapse. I am not saying we are heading for another Great Depression. I am not saying you should sell all your stocks and hide cash under your mattress. What I am saying is that these three specific sectors face acute problems that could manifest in serious ways over the next few months, and that anyone with exposure to these sectors needs to pay very close attention and take appropriate protective measures. The broader economy will certainly be affected if these sectors experience serious distress. Job losses in commercial real estate, auto lending, and banking would hurt consumer spending. Credit tightening would slow business investment. Wealth destruction would reduce confidence in economic activity. So there would be spillover effects.
But the epicenter of the problems will be in these three sectors, and that is where the most severe damage will occur. I also want to emphasize that even within these sectors, there will be winners and losers. Not every office building owner will go bankrupt. Not every auto lender will fail. Not every regional bank will collapse. The companies and institutions that have been conservative, that have strong balance sheets, that have diversified portfolios, that have good risk management, they will survive and potentially even thrive as weaker competitors fail. But identifying which specific companies will be winners versus losers requires detailed analysis that is beyond what most individual investors can do. This is why I am recommending a defensive approach across these entire sectors unless you have specific expertise and information that gives you confidence in particular companies. Let me talk about the broader implications if I am right about these three sectors. A collapse in commercial office real estate would accelerate the transformation of how we work and where we work. Office buildings that cannot be economically leased as offices will need to be converted to other uses or demolished. This will take years and will be expensive, but it will eventually create opportunities for those with capital and patience to buy distressed properties and reposition them. A crisis in auto lending would force a reset in how cars are financed. Credit standards will tighten. Down payment requirements will increase. Loan terms will shorten. This is painful in the short term, but healthy in the long term. It will prevent future bubbles from building, and it will create opportunities for well-capitalized lenders to gain market share as weaker competitors exit. Regional bank failures would likely lead to further consolidation in the banking industry. The largest banks would get even larger by acquiring failed institutions or their deposits. This reduces competition and creates other problems, but it is the likely outcome. It also creates opportunities for technology companies and non-bank financial institutions to take market share in areas where traditional banks pull back. So even in the midst of crisis and dislocation, there will be opportunities. There always are. The key is to survive the crisis with your capital intact so that you can take advantage of those opportunities when they arise. This is why I hold so much cash at Berkshire Hathaway. Not because I think cash is a great investment, but because cash gives me optionality. When problems develop and prices decline, I can deploy that cash opportunistically. But that only works if you have the cash. If you preserved your capital, if you did not lose it during the crisis. I want to close by reiterating the urgency of the situation. We are now in late November 2025. March is less than 4 months away. If the problems I have outlined are going to manifest in that time frame, you need to take action now. Waiting another month or two to see how things develop might mean you miss the window to protect yourself. Review your portfolio. Identify your exposure to commercial office real estate, to auto lending, to regional banks. Make decisions about whether to reduce or eliminate those exposures. Check your bank deposits and make sure they are protected. Talk to your financial advisor if you have one. Do your own research. Think about your personal situation and your risk tolerance. But do something. Do not just hope that everything will be fine. Do not assume that these problems will solve themselves or that someone else will protect you. Take responsibility for your own financial security. Make the hard decisions that need to be made. And position yourself defensively so that if these sectors do collapse as I expect, you will be protected. These three sectors, commercial office, real estate, auto lending, and regional banks, could collapse by March. The warning signs are clear. The timeline is short. The risks are substantial. I am telling you this now because I care about what happens to ordinary investors and ordinary people who will be hurt if these predictions come true and they are not prepared. Listen to this warning. Take it seriously. Take action. Protect yourself. And if March comes and goes without the crisis I have outlined, you can be relieved that things worked out better than expected. But at least you will have protected yourself. At least you will have been prudent. And that is always the right approach when facing significant risks that could cause substantial harm if they materialize. This is Warren Buffett warning you about three sectors that could collapse by March. The evidence is there, the timeline is clear, and the actions you need to take are straightforward. Do not wait. Act now. Your financial future may depend on it.